Hello and welcome to Market Today. I'm Siddharth Zarabi, and with me is Mr. TV Narendran, the CEO and Managing Director of Tata Steel. Good morning and welcome to the show. I want to begin by asking you to take our viewers through the latest quarterly performance and the key highlights.
Thanks, Siddharth, for having me on the show. It's been a tough quarter, because globally steel prices have been impacted by the slowdown in China and the exports of steel out of China. In India, while the demand has been reasonable, but the margins have been under pressure because of this. In Europe as well, we've had a challenging period because Germany, the largest economy in Europe, has been struggling over the last few months. So apart from steel prices being impacted by China, the local macroeconomic conditions have not been great. But overall, from a Tata Steel point of view, the highlights were we started the largest blast furnace in India in Kalinganagar. We commissioned it in September. The Netherlands plant is back to full production. We had issues last year. So operationally, we've had a stronger quarter from both these places. We also closed on two blast furnaces in the UK. We are now transitioning into a newer structure. The second half of the year will see the restructuring of the UK operations as far as the workforce is concerned, which means a lot of the fixed costs will go away. So I think a lot of the work that we had planned to do is happening, but we still have a lot left ahead of us.
Let me take some of those points that you said one by one. As far as the UK assets are concerned, you had recorded an additional 34 odd crore provisioning. Is there any future restructuring provisions that are likely to be made? And what do you have to say about profitability from this asset?
So I think in UK, basically, what is going to happen over the next 6 months is the workforce reduction will happen because we had negotiated a package with the unions. We had waited for the new government to come on board, and that is being rolled out. So we will see a reduction in workforce of about 1,800 in the second half of the year, which is as per plan. And that will continue for some more time because eventually the reduction has to be about 2,500 in the next 18 months. So that will continue, will help bring down the fixed costs. We are already servicing the UK business with slabs and coils from Netherlands and India so that they get converted into value-added products in a downstream facility. So you will see the negative EBITDA of UK reducing over the next few quarters, and we expect it to be EBITDA neutral in the next few quarters. So that's the situation in UK.
Okay, let's go back to Kalinganagar. You made a brief mention of that. So, what kind of contribution do you expect to future earnings? And I want to also tag along the larger debt question with this because we saw some increase there. What's the outlook as far as net debt is concerned?
So Kalinganagar will add about 1.1 million this year to Tata Steel's volumes because the blast furnace has just started, is ramping up. It's already at 50% of the capacity, and it will continue to improve month on month. Next year, we expect to see about 3.5 million tons of additional volume because, again, some of the other facilities will be available by September next year, which is the third caster in the steel melt shop. And the year after, you'll see the full 5 million impact. Typically, in Tata Steel in India, you can multiply by 14,000 rupees per ton EBITDA to get a sense of what that does to what it does to our EBITDA, the incremental EBITDA. As far as the debt is concerned, yes, debt has gone up. It is at 88,000 crores net debt. But this is because of two reasons. One is, of course, the Kalinganagar spend is now peaking as the facilities are getting completed. And the margins have been tighter than we had expected because of what I described earlier in terms of Chinese steel prices. So these are the two reasons why net debt has gone up to higher levels than we had thought. But I think over the next few months, as the Kalinganagar volumes come in and we get the benefit of that, and hopefully steel prices start picking up, we'll be able to bring down the net debt to EBITDA to about 2.5, which is a ratio we're chasing. Just now we are at 3.4.
Okay, 2.5, that's a number to look out for. Let's talk about the broader profitability outlook that you have because at a consolidated level, 760 odd crore feeding in after a net loss. What's the outlook, and is this going to be sustainable over the future?
So there are three buckets to our operations, three big buckets. One is India. And I think India has always had strong numbers. Even this quarter, it's had 20% EBITDA margin, right? So in India, once the steel prices start improving a bit, you will obviously see even better numbers than you're seeing today. As far as UK is concerned, it has been a challenge for us for many years, but we expect that by the second half of the year, we cut the losses, make it EBITDA neutral, and that will be a big help for us. Netherlands has traditionally been a strong business. We are having some challenges. We had challenges last year on operations. That's behind us, but we have some challenges ahead of us from a market point of view, from a transition point of view, etc. So we are working on that. So that's the situation. So I expect UK to get better, Netherlands to have some challenges, and India to get better as the steel prices and volumes improve.
Okay. I want to ask you about a broader macro concern that has emerged after the US election results, specifically the possibility of significantly higher duties on China and, of course, perhaps India as well. Is there any sort of risk assessment that you have done of a possible scenario and whether that could impact, dumping of steel and depressed prices in other markets around the world?
So I think that's something we have to be watchful of. US had already announced that it's increasing its tariffs on China. Trump may increase it, President Trump may increase it further. And
Hmm.
that's been a point with the Indian government that all countries, whether it's Canada, US, Europe, etc., are taking action. And it's important for India also to protect the domestic steel industry, which has been investing and plans to invest a lot of money in building steel capacity. So I think that's important, and that conversation is going on with the government. From a Tata Steel point of view, we sell about 1 million tons of steel from Europe into the US. We are not expecting that to be significantly impacted because a lot of that steel is what is not produced in the US. And in the past as well, when in President Trump's last term, when he had taken some action, we got some release for that. We also expect that investments by European governments in Europe will increase as they try to mitigate the risk of Trump presidency on NATO and European plans, etc., which could be positive for us because if Europe starts investing, if, for instance, the war in Ukraine ends sooner than people think, and there's a reconstruction going on there, all that is positive for Europe. So there are pros and cons. Let's wait and see how it plays out. Yeah.
Absolutely. We'll have to wait for several months. Let's come back to India. And what's your expectation as far as demand is concerned on a holistic basis, including the fact that in the second half of the year, by all indications, the government is going to increase its spending. It had kind of tailed off in the first 3, 4 months of the financial year due to elections here. What's the outlook that you can share with us?
So I think the steel consumption should grow at a rate faster than the GDP growth rate because we are seeing a period of investment-led growth, infrastructure investment-led growth in India. So I expect the steel consumption to grow at 8 to 10%. So and I think construction has been a bit slower than we had thought in the first half of the year. We expect it to pick up in the second half of the year. The weather is better. Normally, it's the right time for construction. And secondly, as you said, more money should flow from the government, which had gone down a bit. Auto has been strong in the first half. We're waiting to see what the second half looks like. But if construction picks up, auto, particularly commercial vehicles, should also pick up. So our concern is not so much demand. Our concern is more the profitability, margins, and we just need to make sure that the steel industry, not just Tata Steel, generates enough cash flows to be able to invest, to build more capacity, because steel is a capital-intensive business, and that's the kind of uh, that's the kind of issue that we are looking at. Yeah.
Given that point that you made in this answer, I have to ask you, what about pricing ability? Do you see that being sort of impacted or come under pressure in any way?
So we've already seen the pressures of China exporting steel at prices at which they don't make money. See, it's not about China being competitive. They don't make money at these steel prices, but they are still able to sell and continue business as if it's normal, which has an impact on the industry because we are all responsible to our shareholders and the financial investors and things like that. So we cannot keep making steel if we lose money, right? So I think that's the part which we need to be sensitive to. And so I think the larger point we are making is this is a great example of private sector investment in India picking up the steel industry. There are not too many examples of private sector investment picking up as far as India is concerned. Most of the investment is by the government. So why derail something which is starting to look good? And that's our fundamental point. India as iron ore, India as a market, India should be one of the biggest steel producing countries in the world. We are the second largest, but China is 8 times larger than us, and that shouldn't be the case. So I think that's our point, and I think we should not just say that good demand is good for the industry. We should look at the whether it's profitable demand. We are not looking for abnormal profits, but enough profits to be able to invest in building new steel capacities.
One final question, TV, and this is to do with the point about private sector. When I speak with other CEOs across sectors, including in this current round of earnings discussions that we are having, uh, the picture is mixed with regard to private sector on a broad sort of industry-wide basis pickup. What's your own reading? Because you did mention certain verticals, including auto, for example, but a broader overview, if you could.
So, if you look at private sector investment, like I said, there's demand growth and it has to be profitable as well, right? Then you can have the cash flows for investment. So I think we need to look at the quarterly earnings. We need to look at the margins being reported. And if capital intensive industries are seeing a compression in margins, that will clearly impact private sector investment. And if it continues for a few quarters, it will show up. So I think we should watch that, and that's our point, larger point, because uh, you know that's something which needs to be encouraged, because it can't be that just the government is spending and private sector is not investing, right? So there are sectors where private sector investment is strong, like electronics is a great example. Semiconductors, electronics, etc. The PLI schemes have helped, but when you look at steel, in cement, the investments are more on inorganic growth. Steel was more supposed to be an organic growth, but if margins continue the way they are, I'm sure it will impact the plans of all the steel companies.
Absolutely, and this is something that the government and possibly the monetary authority need to look out for in the forthcoming months. And just one last point from my side, TV. I was just speaking to someone on the U.S. Elections impact, and I was told that every chip in the world, a semiconductor chip that is being produced, is actually being designed in India. And this was Mukesh Aghi of the US India Strategic Partnership Forum who was speaking to us after the election results. So lots of good tidings, but lots of real hard work that still needs to be done to revive private sector demand and obviously consumption. Thank you very much for your time with us today. Viewers, with that, it's a wrap on this earnings conversation with TV Narendran, the Managing Director and CEO of Tata Steel. We'll see you again after a very short break. Do stay tuned in.